Awesome. All right. Well, welcome everybody to today's you know webinar. We have an exciting deal to share with you today. It's a 62 units in Fort Worth, Texas, and Bruce with Bakerson is a good friend of mine. I've known Bruce for, gosh, probably I think we first met like 15 years ago or something like that, Bruce. It's been a long time, and so super excited to partner up with Bruce and Massive Capital on this deal. And I will let Trevor and Bruce will be the main driver of today's webinar, and they'll share more about the deal. And so thank you so much, everyone, for being on today.
Thanks, Tim, for setting this up. So as Tim mentioned, this is a partnership between several groups. I'm representing Massive Capital, and then Bruce and Ben are from Bakerson. We'll introduce ourselves a little bit later on. And so Massive is partnered with these folks for this great apartment complex. We're going to kind of switch around, and different people will do different portions of the presentation. I'm super familiar with this deal and visited the property myself. And then both Ben and Bruce have been highly involved in getting this deal ready to go. We're very close to the finish line, and Tim's coming in to help bring us to the finish line, Tim and Paul. We just have a couple of more spots left, and we're hoping that that folks on this call today will find this a compelling investment. So
excellent. We got everybody
slide.
rolling in, and they're telling us where we're from. I think maybe what we would like to jump in with it here is the timeline on this. So I think we're coming in like we're all trying to fill the last spots, and the closing on this is coming up pretty quickly. So maybe we can talk about that, and then we'll go into the actual project.
Yeah, so we'll be closing next week. Thursday is our target date, so we have about a week. We do have enough funds already for the close, so this is just to finish out the raise. This is going to be a first come, first to get into the spot opportunity. Once it's full, it's obviously full. We do have quite a bit in soft commitment still, but there's definitely room in this deal, and we think it's a great deal, and we hope that people will join us in this deal.
Excellent. So I think for the remainder of the agenda, we'll go over who the sponsor team is and give a quick summary. And I think we can get through this in 20 or 30 minutes, and then we'll open up any sort of questions. So be thinking about what questions you have, and let's press on. So typical disclosure, make sure you are aware of the investment offering disclosure.
And it is a 506C deal now. It started as a B, but we did switch it to a C. So I just want to make sure that you know that you have to be an accredited investor at this point.
Perfect. Thanks for clarifying. All right, let's jump into the sponsor team.
So why don't you, everybody knows who Tim is. Maybe Paul, I know this is it's a combination of your audience, but tell us, well, actually you've got your slide coming up, so we'll go through it that way.
Okay, let's do it that way. Sounds good. That's fine. All right. So here we go.
So
we'll start with
Massive Capital. A little bit about the Massive Capital team. So I'm on the right-hand side. I'm Vice President Investor Engagement. On the left, we have our lead partners in Massive Capital. So Sanjay Agarwal, he's actually based in the Dallas area and actually started out with single family and then switched to multifamily. He's been a sponsor of about 1,000 units across Texas. With several exits, and he actually owns some single residents in this area. Shrar has been switched over. He's also been a very, very active investor, good friend of Tim's, along with Mike Bailey, who's also in Houston. On the right-hand side, we have our support team. And then most important is the first one is Jen Brown. She's actually asset manager who lives in the market and will be responsible. And Jasmine and Maria help me in the capital raising, and then the rest is just our team. So next we have this is just a little bit, we can skip through this, but these are the markets that Massive Capital invests in.
Yeah, they're aptly named, aren't they? They're a huge capital company that does lots of projects.
Yeah.
Okay.
And then we'll let Bruce start and go through it.
Yeah, so I'm with Bakerson, and just a little bit about us. I grew up in the bakery business in Minneapolis. My grandfather started a bakery there. My father and uncle took it over, and that's where the name Bakerson comes from, to pay homage to my dad, since he's a baker. So I tell people I'm an SOB. I'm a son of a baker, and usually get a good chuckle. So that's where I grew up. But I left the bakery business a number of years ago. But I got into real estate in 2001. And got into single family tax lien foreclosures, and then single family, and did wholesaling. One of the largest wholesalers in Phoenix, did over 2,000 houses in the Phoenix metro. And it was before wholesaling was a thing. It was it was kind of new, in the sense that not everybody knew what it was. Now it's everywhere. Then we got into wholesaling apartment buildings after the market was peaking in 2014, 15, and then we found out it didn't peak. It's doubled or tripled since then, but we thought it was peaking. So we moved into multifamily, wholesaled a couple dozen multifamily properties, and said, hey, we can do our own. So that on the right is our claim to fame. These are the projects we did. Phoenix, these aren't all of them, these are most of them. Phoenix and Market, the Tucson Market, Sierra Vista, and then we have Apex, which is in Fort Worth. But we got into multifamily, what was it, 2014, and we've done over 1,000 units since then, and mostly small to mid-sized projects. Our largest one is 152 units, so we're really done really well on the 75 to 150 units. We're pushing up over 200 on a couple of offers we're working on with Massive for the future. So far we've been getting outbid though, so we're still too low on prices, but we're pretty tough on the purchase side. And then I'll hand over to Ben. He can share a little bit about what his background is.
Yeah, so I've been with Bakerson now for 10 years. And yeah, when we transitioned from the single family to multifamily, I made that transition over, and slowly but surely became our lead acquisitions manager and underwriter. My expertise is working with the lenders, the insurance companies, and doing the front end due diligence package on the property to ensure that we know what we're buying, and making sure that it's a sound deal that we feel that we can be successful on completing our business plan. We have been transitioning. In the past, we did a lot of short flip deals, and now we've been looking for some more of these 5-year deals that we can really get in, turn the properties around, rent them at the market rents, and then enjoy that cash flow for a few years to really optimize the operations prior to selling the property. We've found that the longer you can really optimize the operations, the more you can get for the property, really showing that stable cash flow for at least 12 to 24 months. But if you can show it for closer to 3 years, you can get a really low cap rate in comparison to properties that were just turned.
Right.
And as far as the the Massive and Bakerson, well, Massive is really good on, Trevor would attest to this. They have a hyper focus on the investors and how they can best serve the investors. And we're hyper focused on serving the residents. That's really where our passion is creating a really good home for people that are typically they're self-paying residents, but they'll probably never own a home. And so we try to we work on making places that are owning properties that are safe, functional, durable, and clean, with a really strong focus on the asset ground level. And that's what we bring to the table. But then Trevor and his team in Massive, they've got a hyper focus on the investors. And so we take care of everybody that's involved with the project at the highest level.
Yeah, and I think it's a really important point to bring up here too. 62 is kind of an odd number, right? And just to do 162 in Dallas, there could be challenges, but Apex, the 152 unit, that's located in very close proximity, and it's giving us the opportunity to share some management and some expenses. So this is really powerful. And you've had that property how long now, Ben?
1 year.
Yeah, 1 year.
And super happy, correct? Like with the performance and the property management company. I know we were just on a call before this call. And we're gearing up to take over, and they're ready. Property management companies lined up. And so this is a powerful thing for this project, because it's going to give us some real economies of scale and efficiency, because it is an awkward size to have a full-time manager and or maintenance. And that's a really powerful thing that we're able to do. Plus with Jen and Sanjay being in Dallas themselves.
Right.
Thank you.
And I wanna also add to, like, you guys, Bakerson, you guys specialize, you have a lot of experience in these Class C properties. How many of the properties have you gone full cycle on already?
What is it, 18, 17? I think 17 full cycle. I don't keep as good numbers on as I should, but we've done, we did 6 full cycle in Phoenix and 11 in Tucson. So yeah, 17 full cycle projects.
Awesome. Yeah. And so a little bit about me and our Hero Wealth Partners team here with me and Paul Thompson. I've been in real estate for 21 years now. I've done a lot of different types of deals, from single family to land. And then I've gotten into multifamily about a year ago, and mostly as a passive investor. I'm in, LP in 10 different complexes, over 2,700 units. And and then Paul and I were actually, and Paul will introduce himself in just a little bit, but we're partnering up to launch a fund specifically for Dallas-Fort Worth multifamily. And so we have, we have a lot of specialty, especially Paul has a lot of specialty in the Dallas-Fort Worth area. And so it will be targeting this area quite a bit.
Thank you, Tim. Quickly, me and Tim have combined forces here, and I've been just really pleasantly surprised by the interest in this particular project. My background is, like I think many people here, as I cut my teeth in single family, and then at one point the scales were removed from my eyes, and I realized the power and the benefit of commercial, specifically multifamily. And so I've doubled down on the strategy of multifamily, and I've specifically selected the market of Dallas-Fort Worth, because I recently found out that the Dallas Metroplex is now the 4th largest city in the country. Did anybody else know that? I mean, I do business in Dallas, and I wasn't aware that fact was true. So I'm really bullish on the market of Dallas and the growth in the area. And so my background is basically now focused towards developing and building projects in the Dallas-Fort Worth area. I am now doing ground up development in Dallas myself. So I'm trying to do everything I can to really understand the Dallas market. And I think this is a really strong project that now we can dig into just a little bit more. Okay, Amberwood Apartments, 62 units. I say Dallas, but I mean the Dallas-Fort Worth area.
Yeah, and one of the things that's very interesting about this location is it is 6 miles south of what's called downtown Fort Worth, but this is a C-class property in a very strong, good quality C-class neighborhood. The people that work in this neighborhood, there's a lot of light industrial, there's a lot of warehousing. This is where they live. And then you can see how close it is to several highways. I mean, it's literally 2 minutes off of the highway. So it's a quick commute, but this is a really solid, well-kept asset in an exact market with the right clientele that lives within that demographic. So it's very well located in Fort Worth. And of course, Fort Worth, this whole area is getting regentrified and growing. There's just a lot happening, and its proximity to the great highways is good. I'll let Ben go over because he's much more familiar. He spent a lot more time, but talk about the area, Ben or Bruce, whichever one of you guys. But I really wanted to point that out. I also visited the property and spent a lot of time in Fort Worth. I'm Austin based. I didn't mention that.
Yeah, so I'll quickly cover how we came about it and then hand it over to Ben at the property level. So this property here, we own Apex, which is is known as the Stop 6 neighborhood in East Fort Worth. And Apex itself is a very stable asset right now. It's really running well. And after we bought that, we got a call from a broker that says, hey, I've got a property down the road from that one that's a similar age property, similar type of an asset. It's 100% occupied. Are you interested? And I said, yes. and they were asking 6.2 million. And we said, well, we can't pay 6.2. We offered 5.2 or 5.5, and went back and forth with them for a couple of weeks. And finally they said, hey, the only way this will work is if you assume the Fannie Mae mortgage, because the payoff on it is, 150 or 170 grand, whatever that number was. But it was a huge payoff on the prepayment penalty. So we said, okay, let's run the numbers. We ran the numbers, said, yeah, we'll buy it at 5.5 with existing assumable financing. And so now we have the approval and we're moving to close on that. But the reason it came to us was because we bought a similar aged asset. And I specifically asked the brokers, what does it take to not go for a call for offers? And they said, let's keep plowing forward. If we can come to agreement, he won't take it to a call for offers. And because we were willing to assume the mortgage, we got the deal. Ben, if you want to add in at the property level. Business level.
Yeah, so you got the story down really well. And the main reason that this seller is selling the property is he wants to pay off a few investors that no longer want to be involved in this deal and or multifamily. So he's paying these off. He's getting his portfolio really close within a couple mile radius of each other. And he's done a really good job of starting the remodel. He's shown the proof of concept, and he's known in the market for remodeling well, but renting severely under market. So when we saw that opportunity in combination with the neighborhood that it's in, right there in the red, you can see the subject property across the street is a really clean Chevrolet dealership. So there's people there. We'd like to target that dealership to see if we can get some of those workers to live in the property. There is the Fort Worth Police Department training facility, just a half mile north of here. There's a lot of light industrial manufacturing. It's 6 miles from downtown. There's TCUs up the road, a couple other schools, shopping centers. So there's a lot within a 10 to 15 minute drive of the property. A lot of great things that are going for it. The property, as mentioned, it is 62 units. We already have a property manager that has a staff that he's able to run part-time, so that way we don't have to incur a full 40-hour-a-week staff. He's familiar with this property size and has managed quite a few of them in the past. And it is built in 1969. And as mentioned, the current owner runs everything severely under market rent by about $200. So with that, he's been running it at 100% occupied all the time. From when we did the inspection to every time we've gotten rent rolls, they've always kept it at 100%. If they have a move out, as fast as they can turn it, they have somebody else moving in. Another thing that we really liked with the property is the large unit sizes. There's a lot of 2 bedrooms here with an average unit size of 912 square feet. One thing that I look for when we're acquiring these properties is, do they feel like a home? And this one they have full kitchens. A thing that I mentioned on a previous webinar that I really like is they actually have full dining rooms. A lot of apartments seem to mix the dining room and the living room all in one, where it feels like you have really crammed living, especially if you have multiple people living in the units. As you can see here from those pictures, they're very spacious units, which I really like. One of our core values is, once these units are rehabbed, are these units in good enough condition that we would feel comfortable sleeping in them? If we went to the market and couldn't stay in a hotel, do we feel comfortable staying in our own properties? And that's our goal here.
And one of the things that does come up, there's people that wonder about the older properties and the Class C. And based on the demographics of what's going on in the country today, the lower middle class and the upper lower class self-paying resident is the least served demographic. They've been outpriced in almost every market. We live in Phoenix, and what used to be along Roosevelt, now called Roosevelt Row. The people that work there cannot afford to live there because the rents have quadrupled from what they were prior to the gentrification. No, I'm not against gentrification. I think it's a wonderful thing, but I also know that there's a lot of workers that need a place to live, a place to call home, and that's where we come in. We buy the older properties and make them safe, functional, durable, and clean, and cater to the lower middle class and upper lower class. Again, statistically, that's the largest and fastest growing demographic, and it is also the least served. So there's opportunities in any market cycle to cater to that demographic.
I think what's interesting about that is that that's happening through every metro right now, is that, and where people are wondering if there's going to be a recession right now. and everybody has to have a place to live. And so the Class B and C properties are a kind of convenient place to be with your capital. And Dallas Fort Worth, in addition to that, is also it has a growing population, but there's not very many new units coming on board. And so the demand for this type of unit is extremely high.
And then for those of you who have done the math in your head, 5.5 million is about, what was it? 78,000 a door. Sorry, I'm guessing it now. Is that correct? 87, sorry.
Yep.
Yeah, 87,000 a door. For anybody who's looked at the market in Fort Worth, Dallas area to find anything under 100K a door is unheard of.
And the things to look for when you're looking at a property such as this is there's the underground plumbing, the electrical, whether it's copper or aluminum, whether the plumbing is PVC or cast iron, what kind of problems would you know? And we don't really care what they are. That just goes into what we'll pay for the property, because there's the things that will affect an older property. The number one issue is water from the sky, water from the city, and then water going out to plumbing. So those three things, you have the building envelope to make sure that the water's secure. You have grading and drainage, make sure that the water properly runs off the property. Then you have the plumbing coming in and the sewer going out, and then the electrical HVAC. If you can tackle those things and know where it's at, regardless of what it is, just knowing where they are, that goes into the pricing. So if you have to have, like this one has a couple of roofs that need to get replaced, we know that. We know this one's got some grading and drainage issues by two of the buildings. We know that. We're going to fix that. That came into the pricing. And so those are the things that you want to look for when looking at an older building, no matter where it is what impact do those things have on it. And we're very good at dialing in and spending a lot of time on those issues.
All right, Trevor, do you want to run through some of the numbers here for the investors?
Just sort of, as you know, a very high level of what it is. So this one has a little over than a 17% IRR. It's a 1.95 multiple. This is a 5-year plan is our goal. On average, cash on cash is a little less than 7%. For those that aren't sure what a 7% preferred payment is, that means that the limited partners get paid the first 7% before anything goes to the split to the general partners. So as general partners, we make nothing until at least the investors are paid their 7%. It's going to take us a little bit of time you'll see in the thing a little further. It's going to take us a couple of years to get caught up on the prep. So I want to make sure when you have a value add and a turn, it's a 70-30 split. But if we achieve a 17% or greater IRR, it goes to a 50-50 split. Now, I didn't mention this at the beginning. I'm a passive investor, 21 syndications so far, and this is my preferred model. I get paid first, and the sponsor is motivated to give me a bigger than promised return. And this gives both of those factors. We do say 100,000 minimum, but we are doing 50, something that we can definitely do here. And we are also doing a cost segregation study. For those of you that know and understand the tax benefits, it's gone down to 80 this year, but on 100,000, it will be about a $60,000 tax credit. And again, that's just an estimate. It all depends on your situation and how the final report comes out.
Okay, excellent. I think we've talked about the planned rent bump and the plans for renovations, and this is what the income would be after the renovations are done.
They're already renovated. Those are the prices that are there now.
These are the
and
current.
Then if you look at this, is the one on the right is a comp of another property, and that's what. If you go back to that one,
all right.
This one is Wedgwood Apartments. If you look at the comps, they're at $939 for a classic unit. We're at $879 for a renovated.
So you're unit. Competitive.
So yeah, so we can actually bump our rents up. That's why they're 100% full. And Ben, why don't you talk about that? Because you know about, you mentioned that a lot. If something's 100% all the time, means the rents are probably too low. Why don't you expand on that a little bit?
Yeah, so in my opinion, an optimal way to run a property is somewhere between the 3 to 5% vacancy mark. That's where you found your maximum market rents that you can achieve without having too much vacancy. When you're running consistently 100% occupied, it means you're charging too little. People in the neighborhood are flocking to your property over the other ones, which is not always a bad thing, but you don't want to be too far below market where you're leaving net operating income on the table, you're leaving value of the property on the table. So when you're hovering between 3 to 5%, that's typically the optimal range where you found those maximum potential rents. A lot of people don't look at the compounded interest of the net operating income year to year, getting those consistent returns to the investment group, and also the back end value. When you look at things on a cap rate, every $100 that you can push up on your NOI, that boosts the property value. I think it was by like $700 when you put it on a 6% cap rate. So you keep doing that across properties, across the units, and it adds just so much more value to the property. Also, when we go for refinances or supplemental loans, you have what's called a debt servicing coverage ratio, which is how much more is your net operating income over your mortgage payment. For example, if you have a $10,000 mortgage payment, the lender is going to require that your property is cash flowing at least $12,500 a month, which is called a 1.25% coverage ratio. So you always want to be increasing that value or increasing the rents year over year and maximizing that potential. So that way we can also maximize refinances as well as sales.
So in that situation, basically we're saying it allows you to recapitalize if you want to, because you have room after your DSCR is above the threshold of 1.2, right?
Correct. Yeah. So in part of this model, before we go for the refinance, our debt coverage ratio was around a 1.8. So when you bring that to a lender, they see that, hey, you have a lot of room to be able to then do that refinance. And then you see after the refinance on one of our projections, which we did not include in our modeling here for the IRR, our goal is to be able to do that refi and increase the IRR to the investors. But on one of our models, it goes from a 1.8 down to like a 1.4. So we're still safe in that regard. But we're able to then pull out a lot of cash from the property.
Well, it's nice to know in kind of investment that the operators have options. Like this isn't a sell or bust scenario. There's room to refinance and actually improve the internal rate of return.
Absolutely.
Okay, so along the line of the value add strategy, I think we've talked along some of these. Are there any of these points that we haven't talked about that we'd like to clarify? Like, I don't think we've mentioned the RUBS yet.
So yeah, I'll cover that. So on top of raising the rents, we're implementing what's called RUBS. It's a ratio utility bill back system. What it is a lot of the majority of properties that are built, the landlord pays for all of the exterior lighting and also all of the water, sewer, and trash. And the people who use the most water, sewer, and trash are the residents. So we bill back on a ratio system based on the square footage of the units to recapture some of those expenses. So that way it's not just a pure expense burden on the property. So those will come in somewhere on average between $50 to $75 per unit. So if they're already paying $1,300 for rent, they'll pay an extra $50 to $75 on top of the rent for utilities. And then what we have not put in the model at all, but we are planning on doing is a water conservation program to put in low flow toilets, low flow shower heads, and faucets throughout the property. We wanted that to be a pure benefit, hopefully to the water. It's really hard to underwrite what water savings will be without hiring an entire engineer company to come out and do that study for you. So that's something that we just like to tell the investors. We're going to be doing it, and we're hoping that we can see a good benefit from it, which would then in turn increase those the net operating income. On the outside, we're going to be painting some of the wood on the building, fixing up a little bit of the landscaping, putting in a new monument sign, and fixing a little bit of drainage and grading around the property, just so that way we don't have any low spots. We noticed a couple low spots in the landscaping where water likes to pool after a very heavy rain. So we're going to fix all that. And also, something that does not boost the rents is there are 4 roofs that need to be replaced. We already have that in the budget. The number one complaint when we toured the property and we asked every resident when we were walking all the units was roof leaks. So we'll go and get all those done. 1, to save our buildings, but 2, to keep the resident satisfaction high.
That's awesome. And I actually just realized something that I'm going to come clean on my mistake. I missed one slide when I sent it over to you, Paul. And
Oh, okay.
so that's why I was scrambling looking for the price. So that we are assuming a fixed debt loan at 5.45%. There are 7 years left at that locked in rate. So for those of you that are hearing about all of the craziness with rates, we are locked in that fixed rate. And we're also at a 59% loan to cost. So our value is very, very good. And I know Ben talked earlier about the debt service coverage ratio, but I missed those 2 points and I'm sorry.
Okay,
Yeah,
thanks for
we
clarifying.
At a 60% loan to purchase, which we feel is very safe. One of our goals is not to over leverage the property. We want to make sure during the ownership, especially during the construction, that we can pay that mortgage through the current operations of the property. One thing to note is the seller is not selling this property in a distress situation. He is currently cash flowing the property with the current operations. So we intend to do that and then increase it from here.
And then pull on these additional levers with the water conservation program, raising the rents and the RUBS payback. Okay. I think we had a question here from Nader. It was asking, what about the lead paint? I think you mentioned some of the inspections you did. Does this property have lead paint and have you addressed it?
We have not inspected it. The seller did not disclose if he knew anything. We had asked him. He said he has no knowledge of lead paint. The property manager, what they do is they have every resident sign a form stating that properties of this age may have lead-based paint. We have not done any testing for it. And if it is a pertinent matter that the resident wants to know, that they can do they get a pamphlet from the property manager disclosing how they can do testing and how to protect themselves if they are concerned about that.
So just don't eat the paint, right? Don't lick the paint. You'll be okay. Yep.
I think licking is fine, but eating is out.
It's the eating part that's bad, right? Okay, that's good to know.
But I know we touched on it earlier, but full inspections were done on all plumbing, electrical, roofs, foundations. And you walked every single unit.
Yes. Yep. And
All
we
right,
will inspect it. We will do a small inspection prior to closing too. We have the property manager and Jen from the Massive team lined up. And so they're to do a walk of the property prior to close to make sure that nothing of significance has changed. But it's a well-known and good operator. We're not concerned, but we're still going to do our due diligence.
Okay, so Nader was talking about the some of the Northeast rules. This is like I think the reason a lot of people like the Sun Belt and specifically Texas. The local EPA type laws are just a little more forgiving than they are in Boston.
Okay. Yeah, I see this comment there. We're going to run into a lot of these things in the future years, and we don't have an answer because every jurisdiction is different. But
Right.
But certainly there is as landlords and as owners, we want to do what's right to the residents. But we also have, the realities of an older building, and some of that abatement has been overdone. Some people have these abatements that go out like a asbestos roof. It's outside and it's not an issue on the inside, but yet people have to do an abatement on it in certain markets. And that can be cost prohibitive and really kill a project. So we want to be conscientious, but we also want to be realistic that it is an older property. Yeah, within reason.
Within reason.
So,
all right, maybe we talk about we move on to the timeline. I think that this is a 5-year projected plan. Any additional details here that we haven't talked about that you guys would like to cover?
So our plan is to start distributions in the third quarter. That gives us the opportunity to go in and really start to do the renovations, increasing the rent, and stockpiling some cash flow in the bank before doing distributions. Even though the property is already covering the mortgage payment and is cash flowing, we wanted to build up the cash reserves over the first 6 to 9 months, and then we'll start distributions. But an important note on that is you have what's called, as Trevor said, a 6% preferred return, which means if we don't pay until that 6 to 9 month mark, that is accrued. And either later on in the property, when in the project, when we cash flow the property more, or in the event of a refinance or a sale, anything that is not paid will get caught up at that point. So the first 12 to 24 months is really where all the renovations are going to take place. The bulk of it in the first 12 to 18 months. after we hit the 24-month mark, our goal is to have those monthly and quarterly calls with the property management to make sure that we're managing the property accordingly. We're not going to have any surprise repairs coming up, and we're staying in tune with what the market is doing in correlation to rents. And then around the 36-month mark, we're going to start looking at what it looks like for that refinance or the supplemental loan. There is a slight difference on the refinance versus supplemental for those of you that are not in multifamily. A refinance is you're refinancing the entire property. A supplemental loan is you're keeping your first mortgage in place, and the current lender does a second mortgage, and then you have just one payment. So it's not a different lender that you're bringing in on board. So we are assuming a Fannie Mae mortgage, and Fannie Mae does a supplemental loan, and then they just send you one mortgage payment coupon a month. And then around the 5-year mark is where we are planning to exit the property, but we'll start looking at that around year 3 or 4 to see where the cap rates are, see where sales are in the market, and we'll keep the investors updated at that time.
And although the supplemental loan has been discussed, it is not in the model. So that would positively impact. If we do a supplemental and return capital to an investor, they end up getting their IRR goes up almost exponentially because they have less money in the deal, but yet they're still owners. They're still the same percentage of owners in the shares. So just so you know, the supplemental is a discussion point, but it's not in the model because we don't know where the market will be for cost of loans in 3 years, and so we're being very cautious.
So if you look at projected cash flow on the right, so if you were to invest 100,000, okay, again, you're going to get one small payment in 9 months, let's say $2,500. We're pretty close to the 7 pref in year, and then we start catching up. So that's what I wanted to mention, that, you know, that's what happens, especially with a value add property. You know, one of the things is these units are all rented with leases in place. And so you can't even consider getting a rent increase, doing a renovation until it's renewal time. So that's what takes this period of time. But the beauty of it is this isn't a deep value add where we're 30% empty and we're scrambling trying to fill it at any cost. You know, so this is a really good stable property, and we should be able to grow that. But I just wanted to make sure we pointed that out, you know, so it's, you know, 2.5%, 6%, 8%, 8%, and then 9, you know, that's when you're catching up to your 7 prep. And then of course, on a value add apartment deal, the big money's made on sale.
All right. So let's see, I'm going to open it up to what questions does anybody have on the numbers, if any? Let's press forward.
And I know we did talk about the timing, just to make sure, again, we're closing in a week. We have a few spots left. We hope that you fill one of the spots. You need to reach out to Paul and Tim. Massive Capital, we can help. We help Tim and Paul if they need it. But you're their investors, and so you would reach out directly to them for them to be able to, you know, bring you to this deal.
And this is eligible for IRAs or solo 401ks.
Yes.
So the cash flow that's not coming in the first three quarters typically isn't that big of an issue in those type of environments, because like it's your IRA. You're not like you're going to buy your groceries with it in the first place.
Yeah.
And then if this is in your individual account or an LLC, then you have access to the tax advantages from the cost segregation. So like I think we said $100,000 investment might get you anywhere between 50 and 70% savings on that $100,000 investment.
And I assume this QR code takes you to your portal, Tim, correct?
Correct. Yes. So use this QR code to set up to get into the portal.
We'd love to answer questions. You know, good investors ask good questions.
Yeah. Supplemental, just making sure we have everything going. Okay.
Yeah, and that was just if someone asked about the rehab budget.
We can dig into that if somebody's curious.
Yeah.
Okay, what questions do you guys have?
Okay, we have one. Are we getting the recording session? So yes, there will be a recording. I'll send it out to everybody, and there'll be a link to this slide deck as well, so you can kind of run through the numbers.
And I'll send you that missing slide so you can.
Okay, I'll add that slide into the deck. Okay. Tarso asks, what cap rate did you use on the disposition to calculate the IRR? What cap rate do we anticipate this to trade at in 5 years?
It's tough to tell, but we've used anywhere between 5.5% to 6%, budgeted closer to 6%.
And I think that's a conservative number. Like we're Tarso on projects that I'm using to build multifamily in the Dallas Fort Worth area. We're using 5%. So it's a forecast. It's a guess. I think 5.5% or 6% is for the Dallas Fort Worth markets pretty conservative.
You'll see where the interest rates go. I mean, the Fed's been raising their rates, but the Treasury it was down again today. So
Right.
The Treasury is kind of yawning at the Fed rate increases as opposed to I guess they anticipated it, right?
Well, it's interesting. Certainty, right? Certainty gives them the reason not to raise the Treasury rate anymore, right? So it's when when they're not sure if they're going to raise rates or not is when the interest rates go up. Yeah.
And the last month is, or March 1st, it was the Treasury was at 4, and you're looking at about anywhere from 1.6 to 2.2 above that, depending on what type of loan you get, what discounts you can get.
Right.
So we're at 4, and it's down to 3.39 today. So it continues to yawn at the market. But yeah, they're looking for stability, which they sense that it's priced in the market.
We feel like that the Fed is finished. Like they gave us some early indications that the Fed was not going to raise anymore this year, and they're going to kind of wait and see, because we just found out that the core index for inflation came in at a little under 5%. So it's been working, and so we're hopeful that the marketplace is, or we're hopeful that the Fed is going to wait to see what the market does. One question from Kathy is, what would incentivize the next buyer to purchase the property? Good question.
So there's two different types of buyers. There's the deep value add buyers, and then there's the buyers that are looking for solid cash flow properties that they can buy day one and get that just monthly return. When we've exited our properties, we've exited some of them at top market rents, good in place cash flow, and then that next guy just bought it to sit on it purely for cash flow. They don't like to go through the heavy value add.
Right.
They don't like to go through renovations. Maybe they don't have the team, they don't have the expertise, but they feel like they have a good management play to where they can continue to optimize the rent and or expenses. So that's our target buyer, is somebody that's looking for solid in place.
So is this institutional buyers, like really high-end hedge funds that are looking for a consistent return, versus somebody who has the operations like you guys have to turn these things around?
Yeah, I mean, it's institutional buyer, but on a small level. The property is too small for like the big funds to really take a look at it. But it's going to be your smaller local funds that have a lot of IRA money, 401k money. Maybe they have some small endowment funds, and they need to get that 5 to 8% cash on cash for their investors.
Right. And a lot of times these regional funds will buy it simply for the tax advantages. They're looking for a place to place their capital, because they've done their cost segregation and they've accelerated their depreciation, and they're out of depreciation, and they need to move it into another property.
And this will be a nice size purchase price for somebody coming out of something too, with some 1031 money, somebody who's been in some, because again, it's 62 properties. This is, I'm going to call it the next level up from starter multifamily. And so you're going to definitely have a collection of buyers that are going to want to be able to move into something that's been cleaned up and stabilized in a good, strong area. And Fort Worth is only going to keep growing, which will, give it its long life. Dallas is on fire, as we all mentioned, and Fort Worth is just getting the spillover.
Yep. All right. What other questions do you have? Can you stump the chumps?
Awesome. So again, I don't want to be pushy, but I just want to talk about the time frame, right? There's a few spots left. reach out to Tim and Paul. Tim's at a conference. He's going to probably fill it up with people at the conference. You know, he's should be out in the sunshine in Miami.
Yep.
Tim, any last thoughts?
Yeah, no, so yeah, definitely, you know, if you're interested, reach out to, you know, myself and Paul, reply to, you know, the emails that you've been receiving from us would be good. Yeah, there's many ways you probably know how to get a hold of me, so do that. And looking forward to you know, investing with you and build our wealth together here with real estate, and specifically with this deal. And with that, yeah, thank you so much, everybody, for being here today.
I'm just excited. I've been trying to do a deal with Tim for about a year now. So
It's
Well, I've
time.
been trying for 20 years. No,
Awesome.
Yeah, Tim and I have been connected for quite a while, talking a lot.
It all
Yep,
comes together on Amberwood Apartments.
that's right. That's right.
Awesome.
Excellent. Well, thanks for everybody's time. I will make sure and send the replay and the updated slide with the additional, or the deck with the additional slide that Trevor's going to send to us, and let Tim and I know if you guys have any questions. Thanks so much for your time.